Hi, today we are going to talk about our view on the inflation trajectory, interest rates, monetary policy, and the implication for the markets. In sum, we expect the inflation trajectory to harden going forward. We expect the retail inflation, that is CPI inflation, to head towards 6.5% going forward from the current levels, somewhere around 5.5%. That emanates from multiple variables. Number one, we are observing that government has adopted a sort of a fiscal expansionary policy with revenue expenditure growth at something like 12% year on year, and we are seeing state governments also emulating a sort of a expansionary policy. So that will have a multiplier effect on the economy in terms of aggregate demand. So we expect these things to actually translate into higher consumption demand, and that will resurrect the inflationary trend going forward. Secondly, we also believe that government would adopt a sort of a favorable policy stance with respect to the farm sector, thereby resulting in higher increase in the MSP compared to the last 3 years. So that's number two. Number three thing, along with the modest rebound in global commodity prices and depreciation in currency, there is going to be a pass-through of these variables on domestic inflation. So overall, we believe that the inflationary trajectory will actually come back up again. Our analysis also shows that the performance of monsoon does not have a consistent monotonic relationship or impact for the consumer price index or CPI inflation. Parallelly, we also expect the WPI inflation to also rise from an average of 2.5% in FY16 to something like 3.5% in FY17. That primarily translating from a rebound in commodity prices and depreciation in the currency. What does this imply for the monetary policy? We believe that a higher inflation along with sustenance of liquidity shortfall will constrain RBI from further rate cuts as we move into to FY17. That's the second thing. Then the other aspect is that following the last monetary policy announcement, the market has actually built in a consensus view that GSEC yields will continue to fall as it fell after the last policy announcement from something like close to 8% to something like 740. We think that that kind of scenario is untenable because while the RBI may have committed to actually purchase government securities through OMOs, historical data shows that high purchase of government securities by RBI are generally associated with high yields. That's quite converse to what the consensus view is. Clearly, this is driven by high credit demand, and RBI seem to be monetizing government securities in a way to actually accommodate high credit demand. So effectively, you have high credit demand, high purchase of government securities and high yields. So our models basically indicate that along with higher inflation, high credit demand, and possibly a moderation in FX flows and outflow of a reduction in FX reserves due to redemption of FCNRB deposits that are coming up for redemption during September to November. All these things will translate into yields for 10-year actually rising from the current 740, 750 levels to closer to 775 to 825 levels as we move in the next 12 months time. So that's also sort of a contrarian view compared to what the consensus view that currently prevails. From the market standpoint, what it implies is that the rate sensitive stocks, in particular the banking sector stocks, and within that PSU banks could be vulnerable if this scenario pans out. But in general, we believe that the combination of reflationary fiscal policy and the rate scenario would be sort of positive for the consumption sector in general. So and also that you have the government favoring the rural and farm sector. All those things will actually translate into better earnings and top line growth for the corporate sector. Thank you.